When we hear about geopolitical tensions in faraway places, it's easy to feel disconnected. These events often seem like abstract political chess games played by governments and military leaders. We see the headlines, watch the news reports, but the immediate impact on our daily lives isn't always obvious. However, the reality is that in our deeply interconnected global economy, what happens on the other side of the world can ripple through markets and find its way directly into your wallet. This is especially true when conflicts involve critical regions like the Persian Gulf, a vital artery for the world's energy supply. The link between a distant conflict and the price you pay at the gas pump or the grocery store is more direct than you might think. Understanding this connection is not just an academic exercise. It's a crucial part of navigating our modern financial world. So, let's start with the most immediate connection, the energy markets. Why are they so reactive to geopolitical news? It's because energy, particularly oil and natural gas, is the lifeblood of the global economy. These commodities are not just something we use to fuel our cars. They are fundamental inputs for nearly every sector. They power the factories that make our goods, fuel the trucks and ships that transport them, and are even essential for modern agriculture through their role in producing fertilizers. Because energy is so indispensable, even the mere possibility of a supply disruption sends shockwaves through the market. Think of it like this: the global oil market operates on a very tight balance between supply and demand. Any event that threatens to take supply off the market, like a conflict near a major oil-producing region or a blockade of a key shipping lane like the Strait of Hormuz, creates immediate uncertainty. Traders don't wait for the disruption to actually happen. They react to the risk. This is where expectations come into play. If traders anticipate a future shortage, they will start bidding up the price of oil futures contracts today. This behavior is driven by a desire to secure supply and hedge against future price hikes. This forward-looking nature of financial markets means that the price of oil can rise dramatically based on threats alone, long before a single barrel of oil is actually lost from the global supply chain. This is what we call a risk premium, an extra cost added to the price of oil to account for the uncertainty of the future. Now, how does this spike in energy prices translate to the costs we face every day? The transmission mechanism is a chain reaction that moves through the entire economy. The first and most obvious impact is at the gas station. Since crude oil is the primary input for gasoline and diesel, higher oil prices lead directly to higher fuel costs for consumers and businesses. For the average household, this means that filling up the car becomes more expensive, eating into the family budget and leaving less money for other things. For businesses, from a small local delivery service to a massive international logistics company, higher fuel costs mean higher operating expenses. But the impact doesn't stop with transportation. These increased business costs get passed down the supply chain. A farmer running a tractor and using fertilizer derived from natural gas faces higher costs. That food then needs to be transported to a processing plant, which itself uses energy to operate. From there, it's shipped to a grocery store, which has to pay for electricity to keep the lights on and the refrigerators running. At every single step of this process, from farm to fork, rising energy costs add to the final price of the food you buy. This is why you might notice your grocery bill going up, even if the geopolitical event seems completely unrelated to agriculture. The same principle applies to almost any manufactured good. The cost of raw materials, production, and shipping all increase, and businesses, to protect their profit margins, pass these higher costs onto the consumer in the form of higher prices. This is how a distant event becomes a very personal economic reality. This widespread increase in prices brings us to a major economic concept: inflation. When the cost of everything from fuel to food to consumer goods is rising, that's the definition of inflation. And persistent inflation is something central banks, like the U.S. Federal Reserve, watch very closely. Their primary job is to maintain price stability. If a geopolitical shock causes a sustained spike in energy prices, it can push inflation well above the central bank's target rate. To combat this, central banks have a powerful tool: monetary policy, specifically, adjusting interest rates. When a central bank raises interest rates, it makes borrowing money more expensive for everyone. For consumers, this means higher interest rates on mortgages, car loans, and credit card debt. A higher mortgage rate can make buying a home less affordable, cooling down the housing market. Higher rates on car loans can discourage people from buying new vehicles. For businesses, higher interest rates make it more expensive to borrow money for expansion, investment in new equipment, or even just for day-to-day operations. This slowdown in borrowing and spending is intentional. The goal is to reduce overall demand in the economy, which in turn helps to bring inflation back under control. So, a conflict in the Persian Gulf can lead to higher oil prices, which can lead to higher inflation, which can then lead the central bank to raise interest rates, ultimately affecting the interest rate on your mortgage. It's a complex but direct chain of economic events. Beyond these tangible economic effects, geopolitical tensions also have a significant impact on financial markets through something a bit less tangible: market sentiment. Financial markets hate uncertainty. When the world feels unstable and unpredictable, investors become they start looking for safer places to put their money. This often leads to a flight to safety, where investors sell off riskier assets like stocks and move their capital into safer assets like government bonds or gold. This shift in sentiment can cause broad stock market downturns and increased volatility. You might see the major indexes like the S&P 500 or the Dow Jones Industrial Average fall sharply on news of escalating tensions. This volatility doesn't just affect professional traders on Wall Street. It directly impacts anyone with a retirement account like a 401k or an IRA. These accounts are typically invested in a mix of stocks and bonds, and a market downturn means the value of your retirement savings can decline. While long-term investors are often advised not to panic during these periods, short-term volatility can be unsettling and can have real consequences for those who are close to retirement and have time to wait for the market to recover. Certain sectors might be hit harder than others. For example, airline stocks might fall due to the prospect of higher fuel costs, while defense company stocks might rise in anticipation of increased government spending. This creates a complex and often unpredictable environment for investors. It's also important to recognize that not all geopolitical events are created equal. The ultimate economic outcome depends entirely on how these situations evolve. We need to think in terms of scenarios. A short-term flare-up that resolves quickly might only cause a temporary spike in oil prices and a brief bout of market volatility. In this scenario, the markets might quickly stabilize and the long-term economic impact would be minimal. However, a prolonged conflict or a sustained disruption to a critical supply route could have much broader and more severe macroeconomic implications. In a more serious scenario, sustained high energy prices could lead to a persistent inflation problem, forcing central banks into a more aggressive cycle of interest rate hikes. This could significantly slow down economic growth and even tip the economy into a recession. A global recession would mean job losses, reduced business investment, and a prolonged period of economic hardship. Understanding these different potential outcomes is key to contextualizing the news and market movements. It helps us differentiate between short-term noise and a signal of a more fundamental shift in the global economic landscape. It's not about predicting the future, but about being aware of the range of possibilities and their potential consequences. In the end, global events are never as distant as they seem. They don't remain neatly contained within newspaper headlines or late-night news broadcasts. Through the intricate web of global supply chains, the sensitive barometer of financial markets, and the responsive actions of central banks, geopolitical developments ripple outwards, touching our daily economic lives in countless ways. From the price of gasoline and groceries to the value of our retirement savings and the affordability of housing, these connections are real and significant. Staying informed about how these global forces influence our local economy is not just for economists or policymakers. It's a vital skill for anyone who wants to make smarter financial decisions and navigate the inherent uncertainties of our modern world. Thank you for watching. If you found this explanation helpful, please consider liking this video and subscribing for more content that connects global events to your financial well-being.